Hello everybody, welcome to the 4th UK Investor Webinar. We're very excited to have you join us here this afternoon. I'm Chris Bailey, ex-institutional fund manager, founder of Financial Orbit, and just like you, excited, intrigued private investor. I'm here to host today's event to hopefully provide you with a lot of very useful information, a little bit of entertainment, and actually things that you can practically do in the financial markets. I'm very excited to be joined today by property guru Nick Leslau and Glynis Frew, CEO, and Ed Jones, CFO of Hunters Property Plc. At any point, if you, the audience, have a question, please write it into the Q&A chat and we will try to get to it. After all, this is your webinar. You know, ask whatever you like. We'll try and get to your questions. I would now like to introduce our first speaker, Glynis Frew and Ed Jones of Hunters. Hunters is a franchise estate agency group based in the UK. The group has traded under the Hunters brand since inception in 1992. As a result of both organic growth and acquisition, currently their network comprises of, I'm told, 210 branches after they opened one actually earlier today. The Hunters brand has become widely known and has a strong reputation within the estate and lettings agency market. So Glynis, Ed, over to you. Thank you very much.
Thank you very much, Chris. We're delighted to be here to tell you our story because Hunters Property Plc is an AIM-listed business, and we offer services to estate agents, which proves that really we are a low-risk business because everybody needs a home, whether they are buying or renting. And our story today is about growth. It's an exciting story, and it's about technical growth. But first, I'd like to introduce our team. And I would like to introduce Ed, who is our Chief Financial Officer. And to set the picture, Ed will take us through the results that the company's achieved since 2015, since we floated. Over to you, Ed.
Thank you, Glynis. We thought we'd start just with an overview to give you some context in relation to ourselves. And last year, we had an income generated across our network of 42 million. Now, we call that network income, and just to explain what that means, that's the aggregate of the turnover of all the independent businesses that fall under our umbrella. We are part of that group as well because we have a number of our own branches, but fundamentally we make charges and management service fees on that level of income. So our turnover last year was 14 million. We produced an adjusted EBITDA profit, 2.76 million, and a profit before tax, 2.1, ultimately producing an EPS of 5.86p. Okay, which equates to about 11.4% on our current share price. Okay, now we floated in 2015, as Glynis has mentioned, and in the 5 years since we've floated, we've doubled our network size and our network income. We've increased our profits at both PBT and EBITDA level by just over 150%, you can see. We have issued shares. We do acquisitions occasionally if we see something of strategic value, but nonetheless, all in, we've put our earnings per share up by 61%. We have a strong balance sheet, which has net assets of just over 8 million. We have plenty in cash reserves, 5.6, because we took some extra money to make sure we would get through the coronavirus situation, but we haven't needed to use, which has been great. Our net debt all in sits at less than 1 times debt EBITDA at 2.2 million at the end of the half year figures at June. In terms of shareholdings, we have a very supportive shareholder base led by Nigel Ray, who's our largest shareholder, who many of you I'm sure will know. And the directors and senior managements, we retain just over 50% at 53, leaving us with a free float 29%. Glynis.
Okay, so we're a franchise-based business in both sales and lettings. We started first in 1992. That's when we opened our first Hunters branch. At the time we went to print, of course, we did have 209 branches, but you know, as Chris has explained today, we've opened one today, and so we've got 210, of which 200 are franchised. So we do own our own branches, that's true, and we use those in order to practice different techniques, to test certain new innovative formulas. But you'll also see from the top right hand side that actually we are evenly split. There is no London or regional centric, so we don't need to worry specifically about London centric markets. We have a wide geographic split. We have a balance between lettings and sales, which also minimises risk and maximises the market, because quite often you will find in the market that if sales is growing, lettings isn't quite the same. Having said that, that's not a reflection of today's market, I have to say. And you'll also have seen how, from the bottom hand chart there, how we've grown the network income, so that up to the 12 months to December, it was just over 42 million. And between 2008 and 2009, obviously, you can see that we've grown by 20% in aggregate. Sorry. Okay, so our vision, our Hunters' vision is to be the nation's favourite estate agent. Now, that is a bit like, we use that as a way of making sure that we can galvanise all the franchised branches, because these are independently owned branches. And we liken it to a bit like sort of the American flag. We do it on an emotional basis, because on the top right-hand corner there, you will see the customer satisfaction rating. Now, customer satisfaction is absolutely crucial to us, and we surround everything around the customer. The customer's got to be central to everything. And what we do is on a completed let or on an exchange of property, we phone a landlord or a vendor and ask them about the service and make sure that, you know, the service is good. If there is anything that's not quite right, then we can do something about it. So we make this part of our central philosophy about customer service in order to become the nation's favourite estate agent. But beyond that, there are then business strategies, and we have three. They are build, buy, and improve. So in terms of building, in the last 6 years, we've added 144 branches. So last year, we were the third largest brand for sold subject to contract. Now, our ideal company that joins us would be a conversion. So somebody that is already trading as an estate agent, and then they take on our franchise. And we invest and help them to invest in staff, in training, marketing, compliance, purchasing, and so on. Now, it's interesting actually, because when franchisees used to join us, it was always all about marketing, because we have a very good marketing department. Increasingly, because of changes in the market, it's about compliance, it's about technology, and it's about training too. Yes, marketing is still important, but as the market has changed and as the demands have changed, both from the customer and from regulation, then increasingly it's about compliance and technology. So we have spent a lot of time and a lot of money investing in ensuring executional excellence, because you can have a great idea, but you have to be able to execute it. So we help to build teams, and our systems and procedures make it easy for the teams in order to be able to achieve their objectives and also make it good for the customer. And because we've spent such a lot of time developing systems and procedures, it has meant that we've facilitated an extended geographic reach for each, you know, of the branches and franchise owners that need that. So consequently, they can keep on top of the market, they can keep, you know, local and make sure that they are delivering the best possible service to the customer with the widest geographic reach. And we also have a development grant facility in which we can help people to join us and contribute, you know, from day one. So you'll see there in the bottom right-hand corner how we've grown the branches. The second strategy is about buying. We will buy other franchise operations, providing it is at the right price and it is assisting us in driving the network. The first major acquisition we made was in 2011, which was a very brave move at the time, because obviously we were just coming out of the credit crunch, and then with the former franchise network of Countrywide. We then went on in 2014 and we purchased Hunters West Midlands, and that was part of a brand growth, and then subsequently a network called Country Properties, which is in Bedfordshire, and Besley Hill, which is, you know, in the Bristol area. So each one has helped us to grow our network income, and each one has driven our footpath. The third strategy is about improve. And this is where we gain so much loyalty and credibility from our franchise network. Yes, it's about customer service. Yes, it's about local. And yes, you know, we have a record, even during COVID, a record 97% customer satisfaction rating. But if you look at the top right-hand chart there, the brown block is the market, and the blue block is how our branches have performed against the market. So each year we outperform the market, and we've managed to do that because of the power of our brand, because of our marketing, because of technology. We do not see technology as an end in itself, but technology is definitely an accelerator. It's an accelerator for the users in the branch, and it's an accelerator for the customer. The other thing that we talked a lot about as well was about training and compliance. That is increasingly important. And again, you know, we've managed to help our branches to be ahead of the curve on that. So that growth that we talk about isn't just one-offs. You'll be able to see on the bottom right-hand corner, the network that we acquired in 2011 has grown by 91% since that time. And those agents that joined us 4 years ago have grown by 25%. Now, I'm sure you're all interested to know on, well, how have you actually managed during COVID? Well, I won't tell a lie. When I left the office for the last time on the Tuesday night before we all went into lockdown, then I was pretty nervous. But we had spent a number of weeks making sure that each branch had the technology so that they could remote work, and we had that operational within hours. Now, that set us in good stead, I have to say. Many of the corporates just closed the branches, but with independent agents, where it is the owner that drives the business, that's not good enough. And so we did keep open, and we managed to keep open through technology. And that saved us during lockdown, but more especially when we came out, which we'll talk about in a moment or two. What we also did then, from the following morning, we increased communication exponentially, both internally and externally. So we made sure that all those operators and those franchise owners knew exactly how to manage their business, what they needed to say to customers, what they needed to say to staff. Externally, we increased communication and drove all the digital awareness, all the social media. So our web engagement increased 25%. The time on the website increased by 17%. And we reached almost 9 million people, which was a growth of 53%. Now, interestingly, lettings held up despite the lockdown. That was absolutely because of the technology platforms that we had already introduced, because there weren't many agents that could actually satisfy the lettings demand. And you may ask, well, why was there a lettings demand? The lettings demand was actually quite incredible at the time, because there were a number of key workers that were having to relocate to different areas, be they in the NHS or grocery trade, and we could do all that and do it for them remotely. And that's why, you know, we managed to maintain our customer service level at 97%. And some of the accolades that we got through that time, because we'd helped people to self-isolate or whatever, were absolutely incredible. Nonetheless, we knew that, you know, these were going to have significant implications to us in terms of revenue. So we right-sized the organisation, we reduced our costs, we took some salary hits as far as the board were concerned, but we made sure that we retained the core operations that absolutely, you know, had to take place. And we still continued with our training. So we kept the training department open, albeit on a reduced staffing level, and we converted everything online. Everything went online. We already had some, but we were able to you know, make sure the training continued for those that were furloughed, but also those that were working, and we increased the branches that were fully accredited on our training programme to 114. We then, all the time that we were in lockdown, we were working on, well, what kind of protocols need to be in place for when we open up. And we did develop some industry-leading, both customer and staff safe protocols that are still in use today. So when we came out of lockdown, we did know that there was pent-up demand. We could tell that because our branches were saying so, that were open remotely. So there was massive pent-up demand. And you know, you can see on the top right-hand chart there just how that market changed to like a V-like recovery. Now, there was a lot of talk in the press about, oh, prices will drop, you know, it will all stagnate, it'll all you know, go very badly. But that just did not happen at all in sales, to the point where prices began by holding, and they are increasing in many areas. In fact, you know, there's some new market data out today from Zoopla that says it's anything between 3 and 5% depending upon the location. But in the 6 months to June, obviously sales transactions were down 25% versus the same period a year ago, because you cannot take 2 months out where the you know, sales market is frozen and it not have an effect. Having said that, the recovery has been amazing in that, you know, across the network, in June, instructions were up 19%. By August, that had reached 38%. The pipeline, and a pipeline are those houses that are sold subject to contract, waiting to go through to exchange, was up 43% versus a year ago. And despite the fact that in 2019 there was the tenant fee ban, because of the activity that had taken place during lockdown, lettings up to June, for that 12 months to June, was up 3%, and by August it was up 11%. So what about the future? Well, interestingly, you see, I would say that COVID has changed nothing but accelerated everything, and certainly accelerated everything technical from between 3 to 5 years faster than would have happened normally. Because we're in a market where everybody needs a roof over their head. And Customer expectations have changed, and customers will do things now that probably they wouldn't have done 12 months ago. They are willing to transact online in many, many areas. And so they want to transact 24/7, and they want a choice. They want trust and transparency, and they want to be able to do that and see that when it suits them. And they want speed, and they want everything to happen quickly and efficiently. The industry also has changed its expectations in that it too wants to speed up the process. There is no doubt about it. The time between agreeing a sale to going to completion is actually getting longer and longer. Some of that is due to regulation, and I'll talk about that in a moment. But certainly we need to speed up the process for the customer and for the industry. And also the industry itself wants transparency and, you know, is looking for digital solutions. You'll see on the right hand side, this is a chart from Land Registry, and Land Registry traditionally has always done, you know, things their way. They are also looking at a digital solution. So the expectations of the industry, the expectations of the customer, and then regulation on top of that means that tech is going to be so important. In terms of regulation, did you know, for example, that for every let, there are over 400 regulations that need to be adhered to for every single let that takes place? And that legislation is increasing, and that legislation is also increasing in sales and not just in lettings. And then on top of that, I don't know if you're aware of this, but there is a group, or there was a government consultation called ROPA, which was about the regulation of property agents. That also reported at the end of last year, and that is looking at regulation agents. So all of this has been accelerated and will lead to the future. What are we going to do with that? Well, we've always believed that technology is an accelerator, and our proposition is as a service provider. We will be launching a completely new CRM and tech platform at the end of the year with an inclusive fee, which will drive growth. And as with tech, as we know, you can drive growth, but you don't necessarily have to drive any infrastructure costs as associated with it. So our phase one Skipper platform is due for release towards the end of the year. We're just in business testing now, although I have to be honest and say that is a bit sporadic because the branches are so busy, you know, fundamentally busy, because they're trying to get the exchanges through from the sales and everything. But it's just gone into business testing now. It will allow for transactions to take place out of hours. And where we've tested this before in our own branches, in lettings, for example, it showed that 30% of transactions took place out of hours. That in itself will drive productivity. And because it's tech-based, it can also drive compliance. All those things that agents have increasingly been looking to us to provide for them, we can provide that. And also all those things that the customer's looking for. But we're not just stopping there as far as the customer's concerned, because phase two is about the customer portal. It's about having purchasing power so that at the click of a button we can sort out removals. It's about making sure from our point of view that we have ongoing income, and from the customer's point of view we can create that forever transaction. So we take a customer, hopefully when they're first leaving home, if they first want to rent, right the way through the buying and selling cycle. And also we will be using our tech in order to facilitate and be ahead of the curve with all the regulations that will come in for the regulation of property agents under ROPA. We have our own training academy, and we will all our training is online and will be absolutely up to date in terms of the regulation and qualifications that will be compulsory for every single agent and every single employee. So we believe we have a very, very exciting future. Our Hunters proposition as a service provider. And what I'd like to do now is hand back over to Ed, who will bring it together in terms of the financials for the 6 months to June 2020.
I think I'm on rigid. I think I'm back. Glynis, can you hear me?
Yep.
Yeah. Okay. Thanks, Glynis. Yeah, we'll just finish off really with our half-year results, our interim results for the 6 months to June, just to get you most up to date and up to speed in what has unquestionably been a very, very challenging year. But as you'll see, as we kind of draw these highlights out, some of the points Glynis has been making in terms of its working. Okay, so you can see for the half-year figures, our turnover dropped 18% to 5.4 million, but our profits went up by 30% to 1.4 million. Now, part of that was to do with the right sizing, and part of that was some of the government assistance, some of the grants and rates relief that they were giving out. But nonetheless, our profits have gone up despite turnovers going down, which is our new plan. Okay, we're looking, we produced similarly all the way down through to EPS. So that went up by 33% as well to 3.06, which puts us in a very strong position, as we've mentioned before, with net assets at 8.2 and cash reserves of 5.6. Now, we can't forecast to the end of the year. We're not allowed to do that as we're a listed entity. But if you've seen the analyst note, that was produced on the 29th of September by Dowgate. If you're familiar with those guys, if you're not, you just get in touch and I can help you out with that. But the analyst is forecasting for the end of the year that we should produce an earnings per share of 6.2 and then going up to 6.6. And he's looking at net debt, and that's despite having spent £1 million on the speculative project, which we will have done by the end of the year. Net debt down more towards 1, maybe 1.3, so significantly inside 1 times debt EBITDA. So all in all, we were reasonably pleased with these figures. We were delighted that they came through. As Glynis said, you know, on the 23rd of March when lockdown happened, it didn't look like this, but we're pleased that we've produced a robust performance in what has been a difficult market, and I think proven our business as we'd always believed that it would be. We didn't pay an interim dividend, which you may have seen. But we're in a very, very healthy position, and our proposal is to reinstate our progressive dividend policy and to pay for the year a full year dividend as the final dividend, which will be announced alongside our year-end results come April. Thank you very much. Chris.
Brilliant, fantastic. Thank you so much. Okay, just a quick reminder that if you want to ask a question, please use the Q&A functionality on the system here. Let me ask the first question for you. You talked a lot about change, you talked about technology and COVID, but you also talked about acquisitions. Have you changed your acquisition criteria because of COVID or because of technological evolution? What sort of criteria do you look for when you're looking to expand your network?
I mean, fundamentally, the change hasn't changed at all. We look for strategic acquisitions. If it fills a gap that we need, which we see as the future, then we'd definitely be interested. I'm sure Glynis can pick up some of the operational metrics, but it needs to be earnings enhancing. It needs to take us forward, and it needs to be something that we can escalate and scale across the network. It needs to be useful on a grander scale than maybe it is at the moment. Glynis, is there anything particular we're looking at you want to mention?
Well, yeah, well, I would agree with that. I would agree with that, and you know, I would also say because the market's changing and because we are becoming more of a service provider, we wouldn't necessarily be looking at other agents. Yes, it could be, but we could also look at other kinds of service providers, because there's no doubt about it. You know, COVID has changed nothing but accelerated everything. And we see that, you know, every day.
Great. Got a question here from Barry. It's a good question because it's about balance sheets, and balance sheets are super important in the industry. He asks, Why did debt double from 2018 to 19? Is it being reduced, and to what level?
Okay, like, shall I pick that up?
Yeah,
The
you
debt
pick
went
that.
up because we've spent £1 million on this skipper project, so that put it up substantially. And we also run a funding model whereby if the franchisees want to grow, we're prepared to give them some money to help them do that. So we charge a fee for doing that. And similarly, in the old days, and this has changed really, this has been a change which Brian might be interested in, is we used to attract the businesses across for a number of reasons. But one of the issues that we used to have was, if I had a 200 grand turnover business, why should I give you your 8%? Why should I give you 16 grand a year? You've done nothing for me. And the way we used to bridge that gap was we used to give them the equivalent of 3 years worth of money up front. So we would give them 3 times 16, which is £48,000 to come across. Now, we have previously tried that different ways. We've given them a MSF free period for a period of time. But what we found was they need the money at the beginning when they transfer across. That's when the energy's there. That's when the staff are lifted. That's when the training starts. That's when the extra marketing happens. And what we found is the resulting figures, which Glynis showed you in that graph, were up 25%. So, you know, that's what happened. So that's the way we used to do it. So that put our debt up by doing that. What we found this year is we haven't needed to do that. And we've still managed to get branches to come across because they're worried about price, they're worried about regulation, they're worried about coming across, and they're less worried about what they're giving me for what they used to do. They need our help, and we're helping them. So that's significantly better for our cash generation and our balance sheet.
Yeah. The other thing, though, that I think is important about that business development grant is that's exactly what it was. So although they were given that money, it wasn't such to go on holiday or buy a new car or anything, tempting though that might be. It was also, you know, for them to put in a specific strategy about what they were going to do, you know, to get the growth that they were looking for. So for some, you know, that might have been extending the geographic reach, or, you know, investing more in marketing, or whatever it was. But it was in order to be able to drive that business growth. That's what it was there for. That's why it was called the Business Development Grant.
And as a follow-on, what about dividend policy? Because you touched on the fact that you passed on the dividend for very obvious and reasonable reasons, given the crisis and other challenges. But what about going forward? You're talking a positive story. Surely that means a resumption of the dividend and an exciting dividend payment for investors over the next year or two.
Yeah, and that's very much what our strategy is about, because we're a low cash business, a low cash consuming business. You know, the capital project to build Skipper has been significant, so we've had to bear that in mind. And obviously, previously with our franchise development grant, that's required capital as well. But what we're finding now is we're in a position where we don't have those calls on our cash so much. So we are a very cash generative business, and our intention is either to use that money to find something to grow the business further or better, or to look to return it to shareholders. But our strategy has always been to have a progressive dividend, and ultimately whatever we buy needs to produce enhanced dividends going forward if we don't spend the money in dividends now.
Yeah, I mean, I think it would be true to say this has been a completely different year to anything else we've ever experienced, and it is the only time that we've not paid a dividend. The only time we have a progressive dividend policy.
Been a difficult year. What about the next year? What are your big hopes? What if we could be all here in 12 months' time? What sort of corporate targets or achievements would you like to be talking about?
Well, it is difficult to ascertain what 2021.
We've lost you slightly.
Perhaps you want to pick that one up, Ed.
Well, I'll pick that up as Glynis is frozen. I'm sure we're back in a second, I'm sure. But
yeah,
I kind of
it won't be easy. Clearly, it won't be easy. But if you remember during the presentation, we talked about the pipeline that we already had in the system, and so that will set us off in terms of a good start for next year. And also because of our investment in technology, yes, there will be some businesses that, you know, can't in our market that can't survive. There have been some that have closed already, not in our network. But because of the kinds of things that we've done, we are optimistic for 2021, because at the end of the day, everybody needs a home to live in.
Yeah, so I put that in numbers, Chris, if that helps. I mean, we can't forecast as such, as you'll appreciate, but the analyst has us down at 6.2 this year. He has us down at 6.6 for next year. Now, as Glynis says, we're going to have a very strong Q1 with where the pipeline is. Q2, it's as likely as not all that pipeline will have come through by then. So although Q2 will become the new Q1, which is normally a dip, it shouldn't dip as much because we'll still be starting in a very strong position. But don't forget the underlying point, as Glynis has made, is people need somewhere to live. And there's plenty of people who are looking at relocating because their current arrangements don't work for whatever reason. You know, the whole country is looking at, should I be in the office every day? People who are looking for an open space or an expanded development, all of those people need to move. So there is an underlying pressure to look to move, and moving is good for us.
So is there then a sensitivity in, let's say if we have house prices up or down 5% or rentals up or down 5%, does that change something for your business, or are you broadly indifferent to it? You're there as the middlemen, the people helping to facilitate, as you say, people moving around the property market and the job market and related.
Well, yeah, that's the beauty of the business, in that it's neither, you know, geographic centric, or, you know, that's why it's a safe and steady business, because essentially what we are doing is providing a service to estate agents, and what they pay us is a percentage based. So I won't say that if prices increase, it doesn't affect us. Well, it does to a certain extent, because, you know, obviously it's percentage based on income, but really aligned to that, because of our agreements, we do have minimum fees. And so, you know, we are therefore a low risk business. But what we also do is we make sure that through the services that we can provide through technology, which don't need a massive infrastructure, we can make sure that our franchise partners can actually, you know, make the best of any market that they're in.
And in terms of the very practical post-COVID, hopefully, Hunters network, how is that impacted in terms of office space, people working in offices? Have you always been a business that has embraced technology, worked from home, worked very flexibly? How does all of that impact your business?
Yeah, we've always been a business that's embraced technology, and I think that you know, we do have now, and we've got a few branches that have still gone back to everybody's in the office, but I would say the vast majority are now working a bit from home and in the office. So, you know, some have put their staff onto rota teams, you know, those kinds of things. I personally don't believe it's the end of the office space, as many, you know, have predicted, because I think for lots of businesses, you have to have a culture and you have to be part of a team. And as much as Zoom works and Microsoft Teams work, you know, you still need to be part of a team that you can physically be involved with, because that's what, you know, that's what human beings are. But there's no doubt about it, you know, now, as far as the estate agents are concerned, most of our staff in all the branches have been back for quite a while.
Yeah, and Chris is right, Chris. I mean, the reach of a branch will extend. So instead of it being 2 to 3 miles, it might be more like 5 to 10 potentially in some areas. So you might not have quite as many branches, but the reach and productivity they will produce will go through the roof. And that's all enabled, as Glynis has mentioned, by the technology.
Yeah.
Final quick question from the audience. Do you have a market share that you're aspiring to? And I guess if I can put that into a couple of numbers, you're talking a 210 strong network at the moment. If we pitch it further into the 2020s, is the sky the limit, or is there a practical level that you would want to sort of limit the company to? 200 branches, let's say, something like that.
I'm not entirely sure what I'm allowed to say because we're in, but I would say that you know, our vision is to be the nation's favourite estate agent, and that's always been our vision. So as far as we're concerned, you know, there is no limit to, you know, how big we can become. And because we want to be the nation's favourite estate agent, to me, it's all driven by the customer. You've got to make the customer the centre of everything. And, you know, for the customer to, you know, to get the best out of what is probably the most important transaction they'll ever make in their life, why would they not want to come to one of our branches to get the best service possible?
Absolutely. Sounds fantastic. Glynis, Ed, thank you so much for joining us. Really appreciated the presentation and you answering all the questions. Fascinating stuff, and good luck with the future. Look forward to looking at your progress over the next year or so. We've now got to the point where, no, absolute pleasure. Thank you so much.
Thank you.
And I'd like to introduce our next guest. It's Nick Leslau, who I've spoken to before, and I'm sure is going to once again provide a fascinating insight into the property markets. Nick, I barely need to introduce him, but he's one of the UK's most successful property investors. 30 years ago, he became the youngest chief executive of a listed company, Burford Estates and Property, and he's seen, of course, multiple property cycles. He's the chairman of Pressbury. He's a 30% shareholder in the Secure Investment Income REIT even. Nick, good day to you. Good afternoon.
Hi, good afternoon.
Thank you so much for joining us.
Thanks for having me.
No, pleasure. It's been, well, what can you say about the commercial property market? We're all working from home, or at least many people are. We've got the retail network, property network, under huge pressure because of e-commerce, because of other shifts such as that. Is there a future in commercial property? Is this something which is a huge challenge and massive structural constraint, or do you perceive it as a great opportunity at the moment?
That's a very broad question, and because, you know, one man's crisis is another man's opportunity. I would, however, say I kind of need to sort of split that up into things that have had paradigm shifts, and I don't use the word paradigm lightly, seismic shifts in retail. Glynis made an interesting comment about offices, and I'll come back to that in a moment because I completely agree with her. But if I kind of look at the wider property market, if you look at the share prices of companies like Land Securities or British Land, companies that have substantial retail weighting, so they might be sort of 50-50 in retail and offices, their share prices are back to where they were in 1995, 1996, 25 years ago. That's where their share prices are back to now. Now, the market's not stupid. The market does tend to exaggerate on the way up and the way down, but look at the experiences of Intu, a one-time great retail property company. It's now bust. Hammerson's share price, I think, has gone in the last couple of years from £2.50 to, I guess, somewhere around 15 or 16p. And goodness knows what that's telling us. So we're seeing massive changes in retail. You know, you only have to go on your high street to see how many shops are empty. Hospitality is not dissimilar. And will that ever change? You know, I think there's going to be a hardcore of retail where it becomes less of function, which becomes more Amazon and logistics, because all that's happening is we're using different channels. Instead of buying in physical retail, we're just going online and ordering. So that's, you know, what's been lost on retail has been improved in logistics, which is still part of the property sector, and that's resulted in some eye-wateringly low yields for properties paid in that sector. But what's really happened is that retail has to be physical, or it has to be a functional activity, or it has to be a leisure activity. We go with our mates to go to the shops. Personally, I don't, but I'm not a good shopper, but people do go together in groups to go shopping, to enjoy the experience, and they mix it with other things, other activities. I think that will stay, but I think it's a rather small proportion of the bigger market. I think, you know, pivoting slightly to offices, which I think is much more interesting, because we know the writing, it's not just the writings on the wall with retail, it's happening. You know, your previous presenters were talking about technology bringing forward things 3 to 5 years. A lot of the retailers that were sort of barely scraping a living have actually now been closed out of business because COVID has basically precipitated their demise. It's euthanized these businesses and many hospitality businesses, sadly, as well. However, you know, as to the offices market, which is I find more fascinating, is, you know, we can send people to the moon, but we can't send people up to the top of the HSBC Tower at Canary Wharf, except at 4 at a time. You know, we seem to be grappling with some really interesting challenges, but there are some fundamental things going on behind the sort of the facade of people working at home and it all being okay, because it's not okay. The mental anguish, anxiety and depression that people are suffering working at home, the lack of social interaction, because many young people, most young people, spend more time at an office than they do at home. That social interaction's going, the learning process. I had this one story of a young lady, a friend of one of my sons. She joined a big organization. She's a graduate, super smart young girl, and she's working for 4 directors. She knows nothing about nothing because she came out of university, she's got a degree, but doesn't really help her in the real world. And she's working for 4 directors. She has no one to ask a question to. She doesn't know anyone at the business because she's been working from home. She's lucky to have a job. She can't make a Zoom or team meeting to speak to her bosses. So she's completely intimidated by the process of just doing normal work. And her bosses don't want to be disrupted every 5 minutes with a question. The sort of thing that where she's sitting at a desk near someone else, she could stand up and say, how do you do this? How does this work? That's been played out again and again and again. So whilst these tools of Zoom and Teams, etc., are great for survival, they are not great for growth. And I think we've lost dynamism. I think it's anyone who thinks that office occupation is a line on the P&L is mistaken. It's much, much more than that. It is the essence of most of our businesses, even at the very low end sort of administrative levels. There's another thing that people do not really realize. I'm sorry I'm yakking on because it's quite a broad question, but there's a very important thing that people have forgotten. Okay, those people that say, oh no, I don't want to go on the tube, I'm scared, I don't want to go into work or whatever, it's kind of convenient for me. Employers are working out that actually if that member of staff can do their job remotely, they were previously working in the city, they're now in their place in their apartment in Croydon. If that can be done with technology to the kitchen in Croydon, well actually that can be outsourced to the kitchen in Kerala or Rajasthan at a third of the price. So that person who's sitting in Croydon may well think, well, this is kind of good, I like this or whatever, but actually what they're proving is a point that their job can easily be replaced by shipping it, outsourcing it overseas at a fraction of the cost. People have to be very careful about the choices that they're making now. Equally, those that go in and those that don't, the ones that go in are going to be frontline, being dynamic, interacting, being seen, and the ones that aren't won't be. There is a price to be paid. And I'm not talking now about intimidating people into coming back to work, but I think humanity is such that one, people need to interact to be dynamic. And number two, the businesses need them there in many instances, not in all instances. And yes, it may change the fact we're not doing 5-day weeks, we'll do 4-day weeks, but people who are writing off offices are doing so at their peril, because I just don't believe that that's the case. And maybe the 50-story, you know, 50-story Canary Wharf towers do have challenges, and maybe the trend will be lower rise buildings where you can walk up and down the stairs in the event of another pandemic, or this pandemic, which doesn't leave us. So it's a very long-winded answer. So I think the demise of offices is over exaggerated, but I think retail is absolutely finished, and logistics and other sectors are steaming ahead.
What does all that mean for rental trends? Because particularly you mentioned retail being particularly impacted, offices at very least being transitorily impacted. Surely if you're looking to hire some space, to use some space, you're going to be asking for a 30, 50, 60, 70% discount for next year.
Well, you're right. You're definitely going to be asking for a discount, but why is that different to any other normal cycle? I think what happened in the is actually following the GFC, the global financial crisis. Everyone thought that offices were finished, and actually everyone thought the world was finished, but very quickly, within 12 months, it sort of took off again. And we didn't really have the normal cycle that we would expect. I remember in the late 80s, I'm that old, where we had a property crash, major property crash, where there were cranes all over the central London, and there were millions and millions of square feet of space, newly developed square feet, where the developers had been planning on getting £65, this is in the late 80s, and ended up kind of giving away the space at a tenner a foot with break clauses every 10 minutes. But the market worked itself out. Now, in this case, of course, GDP is a massive determinant of rents generally, because it's, if you want to look at the determinants of property price inflation, watch what happens with GDP. Yeah, and it's not rocket science. It's as you occupy, as the country does better and needs more space, so too, do rents go up. So with GDP going down temporarily, you'd expect rents to go down temporarily, but there is not an oversupply in the primary market in central London. There's just no one in central London. For those of you who have been to the city all the way, I'm talking to you from the West End now. The West End's slightly better than the city, which is tumbleweed territory. Yes, of course, if you want to rent offices, I couldn't even price them for you today. But it is as you described it, a transitory phase. This is not a permanent situation, in my view.
So, in practical terms, we've heard about people like Land Securities trying to evolve their portfolio, become more mixed use, still talking very positively about London. Is that a viable strategy? Is London still going to be this great conurbation for the next generation or so? Or should actually be Land Securities and the others should be looking to the hinterlands, to the warehouses, to the suburban opportunities and related?
Well, I think, should they look to the logistics and warehousing and industrial? That kind of game is done. You needed to be in there much earlier. Today, you're paying very, very high prices to get into that market, and they missed that game. I think they missed disposing, I think they, after the GFC, they distilled their portfolios and they actually did quite well. But the big problem they had was they couldn't sell their retail, or didn't try to sell their retail. But they're not alone. I mean, Unibail, which is the biggest commercial REIT in Europe, or was, I think their share price is down 90% after they had the coup of buying Westfield, one of the biggest shopping centre companies in the world, from Frank Lowy, who'd spent a lifetime building up this business. When he sells, you kind of go, nah, probably the writing's on the wall there. So, when they talk about London, this is unusual. This COVID is very unusual, because it's not really about the property market. It's about people's ability to travel from A to B. And that is also an international phenomenon. What's affecting offices is affecting every airline, is affecting every restaurant, every hotel. It is not a real estate driven phenomenon, which every other crisis, and I've been through a few, has been about. It's a supply and demand question. This is supply and demand, but not of any normal nature. And therefore, I happen to be an optimist, because, our grandparents' generation, if you were born in 1900, you would have, by the time you were 50, you would have been through Spanish flu, 60 million people lost in the World War. You'd have had bombs raining down on you. You'd have had family members killed. You'd have had no food, utter desperation, not knowing when it's going to end. This is history will judge this as a nasty period, but not as, we're very fortunate, because we will create a vaccine, or we will learn how to deal with this, and we will come out of the end. It's absolutely 100% guaranteed we're going to come through this. When, I can't tell you, but we are. And when sentiment changes, it will pivot really quickly, because that's what markets do. They just pivot very quickly. And at the moment, there's nothing but darkness at the end of the tunnel, which is probably the right time to start investing, because we've had 3.5 years or roughly of Brexit, challenges, enormous emotional rifts and challenges to stop, UK companies. I'm not talking FTSE companies that have earnings from abroad. I'm talking about UK companies, and now we've had COVID, and the world has sort of been upended, but it will come right, because it always does. We have lots of experience of seeing Spanish flu and, as I say, world wars and Vietnam wars, and the world comes through. Humanity reinvents itself. So I'm really quite positive that London is going to come back. But in the interim, companies, we saw a rights issue from Shaftesbury, which owns some of the best real estate in London. We've got Capital and Counties, owns Covent Garden. I mean, they're all desperate because there's no people. But that's not really a supply and demand issue. That's no one can travel issue. Much more akin to the terrorism issues that we faced at 9/11, when everyone said, if you recall, no one's ever going to want to occupy a multi-story office tower anymore. It didn't take very long till they did.
So the key is really, as a property investor, is to survive effectively. But perhaps, if you wouldn't mind, Nick, talk us through your own thinking about. Obviously, you've hit the press in the last few days about Travelodge. You've struck a deal there. What's the thinking there in terms of trying to survive, trying to crack on, trying to live to fight another day, in order to benefit, as you say, from the likely return of some of these markets over the next few years?
I mean, in case there's any ambiguity, it's not. I don't think you're talking about our company surviving. I think you're talking about the tenant surviving, because our company mercifully has very low leverage and an awful lot of cash in the balance sheet. So, but when it comes to Travelodge, it's a very interesting question, because I had a mighty bust up with the shareholders of Travelodge when, in fairness to them and every other operator, in the first lockdown, they went from having 550 hotels, and they just reported record trading, strongest balance sheet. They've outperformed every other operator, including Premier Inns, in RevPAR growth terms year on year for 5 or 6 years. And then suddenly they said, we're not paying the rent. And there were 3 things going on. One was they didn't know as no one knew what was going to happen, but they did have a lot of cash in their balance sheet. But the third one was the government stopped landlords from enforcement action against tenants for non-payment of rent. And they took the view this could be really bad. And as things turn out, they were right. Things were pretty bad, worse than many of us thought at the beginning. However, through the process of a CVA, which they did, I've known Travelodge for 12 years. I think it is without question, with Premier Inns, the best operator in the budget hotel sector by a stretch. And whilst they are suffering from undercapitalization, which is apt for sure, they are the best management team, I think, in the entire sector. And therefore, and they also have, when they had a CVA, unlike other CVAs that you would have seen in the retail industry, where they just shed 2/3 of their portfolio and stick with the only profitable units and slash and burn rents, Travelodge stayed with the entire portfolio. They didn't ditch a single unit, which is remarkable, but it's a testament to the value. They don't really have any dogs. It's not a very nice expression, but they don't have any poor performing properties. They've got better and worse. But so, my fight was with the shareholders of Travelodge, not with the management. And actually, there is a bumpy road ahead for sure, but we took the view we're a very well capitalized business. Why would we sell at the worst time in the market a long leases, RPI protection to a company which is best in class? Why would we do that? And the answer is I kind of, pivoted from being a seller to a buyer. And so, yes, we may have to lean in the future, again, because none of us know what's ahead of us. But we've got the best operational group. We've got the best portfolio. They need some CapEx that has to be resolved. But why would we give up the opportunity to earn a ton of money over the next few years to sell it now for what? We can't replace it, not at the sort of yields that we're talking about. So that's really, it was a journey, a very difficult journey, but actually one I feel very good and energized about, because we now have our relationships back. We now understand an awful lot more about what's going on. So, it's gone from, and actually through the process we ran a sales process as well. And we had 6 bids going into a second round from very credible purchasers who bid at or around the current valuation, but they were going to break the leases and take over the hotels. And, that proves to us that our values are right. It's very rare in COVID that you get the chance to prove whether a vacant possession value is correct, but we did. But we just think there's too much growth there to give away. So,
and hence, really, it's a question of maintaining your capability to maintain a portfolio over the potential recovery years of 21, 22, etc. Is that how you view next year and 2022?
Well, yeah. Can I? I mean, I don't want to talk our book because it's very boring for everyone. But when you look at our assets, we specifically choose industries that are not going to come under threat from the internet. Like, we've got 1/3 of our portfolio is healthcare, is hospitals. One of the biggest hospital groups in the world underwrites our very long leases there. If you need a hip replacement, you can't do it online. Okay, our next biggest tenant is Merlin, which after Disney is the second largest visitor attractions business in the world. They had to close down globally. We have the parent covenant. They've reopened, and well, find out for yourself. Try and book a place at Thorpe Park or Alton Towers or whatever. Unfortunately, they can only operate at 50% because of COVID and social distancing. But and again, Travelodge post-lockdown, they've soared. November's going to be tricky, but they really perform very well. And they've proved to us that we've got robust businesses with good managements that as soon as things pivot, they come back. These are not businesses that are under threat. So when I look to the future, I know that we've got best in class operators on very long, very rare leases. And I can't say whether it's 2021 or 2022. I'm not that clever, but I do know it's going to come. And the most important thing is to have the most robust balance sheet to make sure that if we have a national lockdown and they have to close up for 6 months, we can still service our debt. Companies that can service debt don't go bust. We've got, I think, something like 6 years of debt service that we can cover without a penny of rent. So it's not, do you know what I mean? It's sort of not, it's not an existential threat that we're thinking about. We're just thinking about, you've got to get through this period, and then the market will take care of itself, as it always does.
Absolutely. I mean, this is the benefit of a bit of experience. As you say, those volatile markets of the 80s and 90s, etc., that's where you learn. That's where you learn you need to have balance sheet resilience.
And you need to also dig deep, because these are the times, it is strange, fortune does favor the brave, and the volatile times that we're in now will produce opportunities that in a year or 2 or 3, people will look back and go, it was so obvious. And that's what a bear market is. A bear market, markets are tanking as I speak. Well, actually, we're closed now, aren't we? But today has been a shocking day. But you've kind of got to dig deep and look at what in 3 years' time, you're going to look back and go, God, that was obvious. Why didn't I see that? And that's what bear markets are, because we all freeze and we all go, oh, I don't really want to, No, and you always look on the half empty glass.
Absolutely, and of course, back then, one difference was that interest rates were very high.
Yeah,
that caused its own problems in terms of servicing debt and everything else. But also, we've got these ultra low interest rates at the moment. What, therefore, is, from your perspective, a good yield? What is a good yield nowadays? We've got bond yields at next to nothing, negative in some countries, barely 1% in the UK. What does Nick Leslau think is a good yield on a property portfolio today?
Oh dear. Well, I do think on a risk-adjusted basis, you can, if you want, you can buy 4% yield, but yield per se is not a terribly accurate a description of anything, really. It's sustainability of yield. It's how long will that yield last. I'm much more focused on total return. I'll take a 0 yield if I think in 3 years my total return is going to exceed my dividend yield. At the moment, there's an obsession with security of income, absolute flight for, you know, safety, and I understand that, but I don't think it's necessarily terribly intelligent investing. It's just, you know, it's just safe investing. I still think you can get at 3.5% to 4%. You can get some very, very well secured yield in real estate, and I think, but you have to be prepared to live through a volatile period in what terms of, you know, watching your share price. But the direct property market as well, you know, we haven't really had any liquidity evidence of what property is going to trade at, you know, because there hasn't been liquidity in the market. Not because banks don't want to lend, and not because people are willing to invest, but it's quite difficult to get out and about, see property and hustle, and I think the truth is, if you sell a property and you sell it even for a 4% yield that may have been worth 5%, you've then got to go out and replace it. So I think in the short term, there's a lot of speculation about our rents going down, to your earlier point, which I think they are, because the GDP is going down. I think the general economy is having a really tough time. So in the short term, yes, rents will go down. Therefore, what yield can you put on a property? But if you've got a government tenant for 20 years and you pay 3% for it with RPI, that sounds to me like a pretty sensible yield. Get a Tesco supermarket at 4% yield with RPI for 20 years, you know, that sounds like a pretty sensible investment. But I don't necessarily think in total return terms it will outperform something that could have a much lower yield but a much bigger reversion. I know it's a hopeless answer, but it's the honest answer.
I mean, but in troubled markets, in changing markets, this is what happens. You have to think about sustainability, trying to think about the future. As you say, it's about trying to move between being glass half empty to glass half full, and hence keeping sort of eyes on opportunity. Quick reminder for everyone: if you want to ask Nick a question, put something in the Q&A, and I'll gladly ask him for you. Nick, stock markets versus property markets. I mean, we're always told that we've got to be diversified in our investments. Many of us have a house as one of our core investments, so that's a property exposure. Is property still a viable, sensible asset class for pension fund investors, or should actually we be looking towards, let's say, the equity markets, which, as you say, got a bit cheaper today?
Well, I think let's put things in context. The real estate market in its entirety, the REIT world in its entirety, is probably capitalized. I haven't looked recently. It's probably something like 50% of the size of Vodafone. Okay, the entire real estate quoted sector. So it's tiny. And yet it's the biggest asset class on the planet. There is, you know, everyone operates at some level from a piece of real estate. So there are many ways to get involved in real estate which don't involve the equities market, because there is enormous dislocation sometimes in property markets, but there's opportunity in that dislocation in the quoted sector. But you have to be pretty careful about what you're doing, because, you know, liquidity, the attraction of it is liquidity. So, you know, in the bigger companies that you can, you know, swill in and out of it, whereas direct real estate or close to direct real estate is very illiquid, and sometimes you have to lock your money up for a long time. So, but I would say this is not a terrible thing for me to say this, but I would say for the faint-hearted, this is not a time to be buying real estate, or directly or indirectly, because we haven't had the fallout that I would have expected, that only more liquidity will demonstrate as to what real value is. And I think the discounts that we're seeing in some of the property companies may end up not being much of a discount at all. So, you know, there are some very good property companies that might be trading at a 20 or 25% discount that prima facie look cheap, but I think that 20 or 25% discount might end up only being a 10% discount. because values come down. Even if they've got no leverage, it's still, it's still, so I would be a little bit cautious. I'm certainly, being very cautious, as indeed we have to be on most things, because we just, it's that lack of visibility. But I totally do believe in market sentiment will pivot, and when it does, it will pivot 25% almost overnight, and we'll kind of go, damn, I missed that, and then it will kind of trundle on. But I'm not quite sure when that is, but I hope it's not too far away.
Urbanisation, it's been something that people have talked about for many years, saying it's an inevitable trend that London's going to be some massive conurbation of 30 million people in due course, among other cities around the world. Is that still likely? Does the whole work from home, e-commerce revolution change that? And hence, does it keep your focus in London, or does it mean that you should be looking at regional opportunities around the whole nation?
Well, we actually own nothing in London, apart from our head office. We don't own anything in London. We tend to own everything outside London in the areas that we're invested in at the moment. I think, again, we're back to this issue, and it's not a London exclusive issue. It's a New York issue. It's a Paris issue. It's a Berlin issue. It's the same problem that's a massive better on answering that question, because I do think London will always be London. I don't think we can't, on the strength, legitimately, after 25 weeks of COVID, I mean, in it impacting our lives, turn around and say that that's the end of London. I just think it's a completely foolish thing for anyone to be suggesting. But London needs vibrancy. It needs its culture. It needs its theatres. It needs its restaurants. It needs the international travel. It needs all the things that make London sexy and a place that we love and want to be part of. And that's missing. That's the missing ingredient. So, when you watch TUI and see what's happening with the airlines, and that's going to be, to me, an indicator of, when things are coming back. Because I don't know about you, but I am yearning to travel. I am desperate to travel, because I love travel, and people must be doing the same overseas, wanting to come. I think we all are just desperate to travel, and we're just scared of traveling at the moment. And when we become unscared, I think London will pick up very, very quickly. I really do, because it's one of the great capitals of the world. But then we have to go now, and then we have to start building new restaurants, and the theatres have to build back up. And so we are going to have a cycle that's going to kind of, but once it gets the steam going and the momentum going, it will happen. As sure as that, London will always be London. It will ebb and flow a little bit, but as indeed will Manhattan always be Manhattan, or Paris. We just have to wait a bit, frustratingly, before we can sort of go back there.
And talking about returning to previous kind of preferences, what about the pub sector? People think the pub sector and pub investment's all about whether you can get people through the door. Clearly that matters, but there's also a big property element to it. I mean, Li Ka-shing bought Green King a year or so ago. Probably not the best timing, but there you go. I think you can probably just about afford it. What do you think about the pub space? Is the pub space going to be of interest going forward or not?
Well, I think the problems are not pubs, because I personally we don't have very many pubs, unfortunately, but I think pubs are very interesting, and the pubs on the whole, especially urban pubs, because all the EBITDA, all the earnings come from the ground floor of the pub, whether it's food led or booze led, and then you've got the residential upper parts. So actually you buy based on a multiple of the earnings from the ground floor, but actually your underlying security is the fact you've got residential upstairs that can be worth quite a lot of money. So I like pubs. The problem with pubs is that the owners of these pubs have got massive amounts of debt in securitized vehicles, CMBSs, etc., against these assets, which means that they are probably if not in every case, in most cases, underwater. And that means they are very restricted and fettered in terms of what they can do with their pubs. And the reason we all know is because you can't really go to pubs in the way that we used to go to pubs and desperately want to go back to pubs. But they had a problem before COVID that they had too much debt. And now with the loss of earnings, it's just magnified the problem several times over. So I think the pub companies are, are challenged. They're really challenged. And it's desperate to see the publicans and people who've got, some Trio Tile, whatever, pubs, indeed restaurant operators, that whole hospitality sector, just, this damn COVID just kind of killing those businesses. And the only hope is that, and it's more than a hope, it's a belief, but that they can be rescued, because at some stage they'll come back. It'll be off different rent levels, it'll be off different trading patterns, but they will come back. I'm sure of that. But there's going to be a bloodbath amongst the owners of those assets, because the debt, they'll be in the hands of the debt owners and not in the hands of the equity owners.
Dream property that you don't own, Nick. If you could buy any property in the world, or let's say something in the UK to keep it a bit more local, what would it be and why?
Oh, sprung that one on me. What would it be and why? Gosh.
Think about it thematically. What would, I mean, you've talked about sustainability, something where you can not only service the debt, but there's some real rationale for it in a strong location.
Well, I suppose, our exposure to the healthcare, acute hospitals, has demonstrated just how valuable those are. And I suppose if I could own any assets, I'd probably own some hospitals in central London, because they are, it's estimated that by the end of this year, there'll be 10 million elective surgeries that have built up over the course of the last 12 or 24 months. And the NHS can't cope with dealing with them. And the private sector is incredibly, is going to be incredibly valuable to solving that backlog, and it's going to take years, and the problem, and I feel sorry for anyone who's got pain in their knees or hips or shoulders and they need elective surgery. It's going to be, and there is a growth going on at the moment, funnily enough, in private insurance, private medical insurance, because people realize that they're not going to get these operations on the NHS. And so I think if I could I'd own one of the really fancy round the corner Harley Street hospitals, or a few of those. That's, I think, where I'd like to be, because I can see those being in huge demand. Whatever happens with COVID, our hospitals were taken over by the government. Every one of them were basically sequestered by the government, who paid all the outgoings to deal with electives whilst they were dealing with COVID. That's how valuable they are to the government. Of course, the hospitals want the hospitals back so they can do their more profitable surgeries, not the NHS work, which isn't terribly profitable. So I suppose that's my rather ruthless clinical answer to you is I'd like to own some very nice private hospitals in central London.
It's sadly a necessity business. We all at some point probably need to use them. So there you go. So in essence, Nick, where we've got to is this market is troublesome, but as an operator, you say focus on sustainability, focus on having good relationships with your tenants. You are probably going to have to accept some form of rental decline short term, but if you have strong relationships, you can work it through. The commercial property market is not dead. There's still opportunities out there, harder in retail. We should all get back to the office, and you'd love to own more hospitals, theme parks, and a few pubs here and there.
Well, I think that's probably a good synopsis. But I think as an investor looking at which companies to invest in, the same thing applies today as has always applied, which is it's about the management. The management will make you a fortune or lose you a fortune. And I do genuinely believe that there are some very good companies out there, but I'm not sure about the timing. So and people do say to me, should I buy some property shares now? They seem very cheap. The discounts seem very marked and, and uncharacteristically large. And I'm like, not yet. I don't think it's the time yet. because we haven't got enough transparency. So all of those things that I'd like to buy, I would like to buy, but I'd like a little bit longer. You know, some of the things that we own, I'm very happy owning. I'm very happy that having come out of lockdown, we've seen how quickly they've been restored to health. But it doesn't mean there aren't going to be more lockdowns, and it doesn't mean they won't suffer. But the point's been proven, you know, the point's proven, and it will be proven again. But cash flow, it's all about sustainability and cash flow. Every business, isn't it?
And as always, what's factored in, and as you said already, warehouses, you can see in a logistics centered e-commerce world why warehouses and distribution are an integral part of that. But we all know that already. It's still largely factored in. People who've got those great assets, they're in the box seats. But that marginal dollar, that marginal pound going in is probably not going to be as remunerative as those.
Yeah, but you know, it's very how quickly things change. Supermarkets, 9 months ago, people were not really interested in supermarket investments. You know, they were one of the poor performers in the real estate sort of firmament, and they've suddenly switched to being highly desirable because of COVID. It's not because supermarkets stayed open, they serviced people, you know, they made money, they did. It wasn't underlying real estate rationale that kept them that have seen them go up in value. It wasn't that these are great property assets. This is great income when it's difficult to find great income. Yeah, Tesco's is a great covenant. They're not going anywhere. Sainsbury's is a great covenant. They're not going anywhere. So that assets become valuable. But that doesn't mean that it's a good property deal. It just means it's a secure income. And you have to make a decision. Do you want a secure income with some value volatility potentially, or do you want a total return because you see opportunity in some area? And I think our share price is suffering from, you know, people going, well, you're in leisure and your hospitality and that got closed down and it's terrible. And the answer is, yeah, absolutely. That's what did happen and it could happen again. But the question is, have you got best in breed operators? Are you going to be, will they be back in business when the world sorts itself out? And can you buy it so cheap today that you'll make a ton of money going forward? And that's the sort of discussion that we have, why management bought some shares and, you know, who knows, may buy more shares. But, you know, those are the investment decisions that we have to make. And it's difficult today. So I'm certainly not saying to anyone go out and buy shares in real estate, because I think there needs to be a bit more clarity.
Fantastic. Great way to end the conversation, Nick. Thank you so much for your time. I really appreciate it. As
Thanks,
always, fantastic range of insights. Thank you so much.
Nice to see you.
Thank you.
Cheers.
So thanks to Nick, thanks to Glynis, thanks to Ed, who joined us earlier from Hunters. Hope that was interesting. Lots of insights, lots of thoughts. Thanks again for sending over some questions that I could post to them. I also wanted to say thank you very much to the UK investor team, particularly Hannah, for helping put together this this webinar. Hopefully it's all worked well from your end. Seems to have worked well from mine. So thank you for joining us. Really appreciate it. We've got more of these webinars coming up, so keep a look in your inbox for all those opportunities. Hope to see you again very soon. Again, you hopefully will have at some point some physical investor show for you as well. So thanks very much for joining us. We really appreciate it. Keep safe, keep thinking about the investment markets, and keep coming back to these webinars in the future. Thank you very much and good evening.